You do see the world moving away from the dollar, so that actually puts more pressure on the U.S. to try to get its house in order. The world's not going to finance it, but it's moving in that direction to where the U.S. won't have the ability, that it's abused to finance, the way it has been able to finance. We're going to be looking at the U.S. still being a, reserve type currency, for the foreseeable future, but its position is certainly weakening, and that's what the gold market's telling us.
Greg Orrell, President of Orrell Capital Management. It's a true pleasure to host you on Palisades Gold Radio today.
Great, Stijn. Happy to be here.
Excellent. Really excited to hit the ground running. I'd love to start with precious metals. Most of them are up well over 50% this year thus far. Is this like any other time you've seen in your time in the industry?
This would be certainly an outlier. Normally you would get a 20% move. That would be a big year. But 50% move really speaks to, I guess, what is going on in currency markets, and what the perceived culmination of building up all this debt by governments through the years has kind of led to this moment that we're in right now.
Yeah, would love to dive into some of those fundamental drivers in just a second. Before that, perhaps we can dive into your background. We spoke off camera. You mentioned that you've been in the industry for about 40 years at this point. How did you get to this point, Greg?
I started off, right out of school, out of college. My father was a broker, and so he said, well, why would you want to go work for somebody else when you can, basically go work for yourself as a, broker? And so I started off doing that. He was in the mining business. He had started a mining company in California, in the Mother Lode Belt of California, that ultimately became a mine with Burlington Resources. And so I have seen the gold market, from a mining side, from a front row seat, so to speak. And so I've been there, done that. He looked at gold from a monetary standpoint, and that's why he was interested in starting a mining company at the time. Nobody really was into mining gold as much as they are today. Back then, a 700,000 million ounce deposit was a big deposit. Now it'd be marginal to actually start a mine with that. So that's how I started, and then I started doing retail and institutional brokerage, and one of my institutional clients had this small fund, and they thought that I would want to run it. So I said sure. Little did I know at that time that I thought the gold price was breaking out in '96, and it poked its head up above 400 and immediately went straight down to 250. So the timing obviously wasn't that great. But I got the fund was small, got it to break even, and then kind of rode the wave in the 2000s, and then the kind of the bear market started for the gold shares, as the rest of the market was taking off. And that's really where gold is, in the contra-cyclical cycle is where it plays out the most. And so when the broader market's doing well, gold tends not to do as well in gold assets. So that's kind of the 2-bit rundown of how I've come to be in this business for 40 years.
Yeah, incredible to hear those figures. $400 peak in gold, bear market $250. What a time to be alive compared to now $3,900. We're flirting with that number on the futures market as we record right now. Just an incredible comparison. Would you describe yourself and the fund that you're running now as a value investor, as a speculator, short-term trader? Really, what term would you describe yourself, and what philosophy do you think that you follow?
Well, our turnover rate's very low. It ranges between 3 to 11%, and so long-term investor, like to buy stocks that where I can look out and say, okay, 5 years from now, what does this look like? And so that's one of the characteristics of the mining business is, okay, can you see where this company's going? and a lot of them can't replace reserves, or they don't have a mine that is going to be long lasting. So you have to really be able to basically look into the rocks and see where are you going, and do you have the management that can handle it. So so I would say value investor over definitely look for longer term assets.
Really excited to start talking about some of the criteria that you're looking for that long-term bet, that long-term value investment. Before that, I would love to touch base on gold for a second. From your perspective, what is happening to gold and precious metals right now?
Well, gold is having a moment, so to speak, and that moment is really driven off of total federal debt. And if you look across, whether it's in the U.S. or Europe, government debt is a problem, and I think maybe you've reached that tipping point to where they can't see an end without having further debasement. And and I think if you look at where the buyers are in the U.S. specifically, the buying of gold assets has been they've been very late to the party, and maybe a few of them are buying, but I would say still the money is not, the big money is still not positioned in gold. And you probably do need to see the NASDAQ roll over for that to happen. I think gold tends to be the asset that people reluctantly buy, and you would rather be looking at growth in the NASDAQ or the overall economy, rather than looking at gold as having a more of a safety net type of asset. You want to be full bore into the growth. But I think that's where people get it wrong, is they should be positioning whether it's kind of having a 5% position long term, or a 10%. I mean, if you look back over time, if you had a 10% plus position in gold, I mean, you've done very well over time. And the debasement of currency is ongoing. I mean, until there is a real definitive move to try to have a sound currency, I mean, you're going to continue to debase it. And so what might look good back in if you go back into the in the move in the 70s, and gold shot from $35 to $800, and then settled into that 400 to 500 range for quite a few years. That was a move that was based on the Nixon closing the gold window, lack of discipline, and that lack of discipline has continued. And I see that until you get discipline into the system, gold's going to have these periodic moves where it runs hard and then establishes new base. And so whether that new base is $4,000 to $7,000, that's kind of what we're looking at right now.
All right, that currency debasement angle is definitely well noted. Talking about the US government for a second, they are apparently shutting down, or at least on the cusp of, or have shut down already. How is that playing into the gold thesis? Is that changing anything?
Well, I mean, it's great. It's what it does is on a short-term basis, it gets traders to cover their shorts, and that tends to be a short-term phenomena. I mean, that's not really what is going to drive the gold market longer term. And we really do look at it from a longer term perspective. And these little flurries that you get with a government shutdown, what they do tell you is, do you want to be chasing right this minute? Probably not. I mean, the last time Trump had a shutdown, 2018, I believe it was. He had to shut it down for about 35 days, and the gold market will run during that period, and then you get some type of resolution. It'll pull back, and the traders will then cover their short positions that they've put on during this period. So it's not really. I mean, it might be a tradable event right this minute, but for longer term investors, it's not the reason to be buying gold assets.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades, Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisade shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. No, that makes sense. No, definitely. Talking about discipline in government, however, a resolution to this problem could be more government spending, even larger deficits, and it could be another tailwind for gold, I suppose.
Well, yeah, I think what people had hoped for with Trump was that he would actually have some type of discipline. But I kind of look at him as he's kind of a classic real estate developer type. He likes easy money, and easy money is definitely gold's friend. From a price standpoint. But, you still look at gold and say, okay, an ounce of gold is an ounce of gold. I mean, that's one of the things, you learn early on in your career, at least, having come from a family that was believing in gold. So, it's really the dollar that's going up and down versus gold. And so if you look at, gold, right now, you'd say, okay, well, the price is $3,800, but really, what does that represent? That represents, you could go to Mexico and Venezuela, all these countries that have debased their currency, and that really just comes down to poor management of the currency.
Are there parallels in history that we can draw upon to really look what this scenario could play out like?
Yeah, that's a really good question. Is this like France? Is this going to be a German Weimar Republic type of situation? I don't think so. I mean, you do see the world moving away from the dollar, and so that actually puts more pressure on the U.S. to try to get its house in order. That the world's not going to finance it, but at this time I don't see what that that alternative is for the quote unquote free world, but it's moving in that direction to where the U.S. won't have the ability, that it's abused to finance, the way it has been able to finance. So, I think we're going to be looking at, the U.S. still being a, reserve type currency, for the foreseeable future, but its position is certainly weakening, and that's what the gold market's telling us.
That draws me to another angle that could be a wind in the sails for gold. Of course, central bank buying. It's something that the precious metals sector really focuses on. Is that on your radar as well? Is that one of the big drivers behind it, or mostly currency devaluations, or do these go in hand in hand?
Well, they certainly go hand in hand. I mean, if you are a central bank and you want to try to maintain reserves, I mean, you've been holding dollars, and all you're seeing is that the U.S. continues to drive large deficits and is not taking care of its business. You're looking for that asset that's going to maintain its value over time, and so looking at where the foreign central banks are, I would say that they're going to continue to drive demand, and whether that's I think it's inelastic demand, because they don't care if they're spending $3,800 or what they're spending to buy gold. They're looking at it from a long-term standpoint. And so without the confidence in the dollar being able to maintain its value, I think you're looking at global central banks looking at gold as still a place that they want to secure a certain amount of stability long term. So I mean, what you do see is China and a lot of Eastern Bloc countries wanting to move away from the dollar, and that they're still looking at China, being in a position to where they position whether it's Russia or other countries to be able to trade with them, and gold is being that asset that will allow them to trade. So I think going forward, gold has a certain role to play in the monetary system, as it has for thousands of years. And I think what people got lost on is they get all excited about cryptocurrencies and other things, whether that's paper currency, but gold continues to be the asset for international finance.
And for the generalist investor that might just be stepping into precious metals or gold for the first time, is it too late to take up a position?
It's not too late to take a position if you've never had a position. Will it go up and down? Absolutely. And so you have to pick your spots, but I do believe that you have to look at it like foreign central banks are looking at it, and that you want to have a long-term stability anchor to windward, so to speak, and that's where gold comes into play here. So the gold, for the miners, for example, the miners are just over this last month especially, they have played catch up to where the gold market, with the belief that the gold price is going to be 3,000 plus going forward, and everybody had been looking backwards and saying, "Oh God, gold is the banks were still in the $2,000 range," and I get that. I mean, if you go back and you look at where historically the best way to evaluate long-term gold price was, just take the simple 10-year average, and if that simple 10-year average, that would usually give you a good idea as to how to evaluate a gold miner for a price standpoint. Well, the banks would all have a negative gold price regression to where it would go from they'll have $3,000 gold and then going down to $2,000 gold, or some number like that. But for a long time, the banks have not been stepping up to a gold price, and I think you're starting to see a bit more comfort there, but still a lot of them don't follow the forward curve at all, and so the gold market can certainly really drive further value for these miners. And I also the other thing too, Stijn, is that kind of similar to the oil companies, the last cycle, the miners were undisciplined, and they had a lot of dilution, and and I think what the oil companies found is they found that discipline, and then the money started to move in their direction, and they've paid dividends, and I think that the miners have kind of found that religion, which is a good thing, and I certainly think they make them more investable and to attract bigger, longer-term capital to the space. It's just not looking to rent the space for 10 minutes.
Thank you for bringing up gold miners. Would love to continue talking about that, and also including the topic of beating the market, because your fund, the OCM Gold Fund, seems to have done that on a 10-year time frame. I would love to dive into really what your competitive advantages are, your secret sauce, really your strategy behind that. So what would you say that is?
It's all up here, Stijn. No, I think just having the ability to not just take all majors or all intermediates. our fund has has progressively established its structure as, okay, you'll own the majors, you'll own the intermediates, you'll own the junior producers, and you'll own exploration and development companies. And as you get into a bull market, you'll increase that exploration and development position a bit more, but you can't go crazy on that side because a lot of them, certainly as Mark Twain said, are holding the ground with a lighter on top, and so you've got to be careful that you don't get stuck in projects that are just a hype. You want projects that are going to come into production. I like to say in my career, which is getting shorter, but with that in mind, that also means there's fewer projects that can make it through the cycle. I mean, it takes about 10 years to bring a mine on. A good one comes on in 7 years, but if you look at a lot of these projects, it's 10 years in the making. I mean, you better have some pretty good returns for 10-year cycles. And so that means that you have to have what worked at $400 gold, $1,000 gold, $1,500 gold is the same parameters that you want to use kind of going forward, because costs do change, and you have to be in position to be able to get out of stocks that aren't going to work. So what you'll see in this cycle is projects will move, and people will get excited, but that might be they might not make it through this cycle and come into production, and so they'll roll over and die off, to have to go through a recapitalization, etc. Or they'll get bought out by some majors. I do believe that the majors are that's probably one of the steps that will come next. Is the majors will start to deploy some capital to projects that they like, and they can ride those waves of that long development cycle, and I do believe that they need to use their expertise to buy assets a little quicker than waiting for to get all the way to the end and in permit before while it goes up the value curve and they pay more. I mean, a good mining company will actually step up and buy earlier, believing that they have the talent to take a good project all the way through. And there are some decent discoveries, and this latest wave of financing that's been going on. I mean, this is one of the things that maybe makes one pause a little bit right here, is that every day you're seeing 2, 3, 4, 5 financings, and that usually is then followed by a bit of a sell-off that then is followed by another move that comes. Especially all these companies that are raising money, they will have results that come out that drive their share prices, and so it's a good thing from a longer term perspective that you're getting the financing that this industry has been starved for exploration, because it's definitely a capital intensive business, that needs the money in order to fund the next growth. And so we're gonna see some good discoveries come out of I think we'll see some good discoveries anyway come out of this exploration spend that's going on. I mean, some companies I will say that they're living by the motto of, okay, well, you have to get money while you can, when the market's there. I don't necessarily believe in that. I think that that's a bit short-sighted by some companies. I mean, there was a company yesterday. Unfortunately, we own it, but they had $20 million in the bank, enough to get them through a feasibility study on their project, and they went out and raised $30 million. So I think that's the wrong tack to take. I think you still have to hold equity dear, and that's one of the things that in the last cycle that investors got upset with was the management team's not holding equity dear, and this is all on a per share basis that you're trying to drive value. And for investors, what you want is you're looking for that growth of gold per share and production per share. All those numbers are important on a per share basis. So so companies that are that are just raising money just to raise money to have it in the till because they think that the cycle is going to be over in 10 minutes. You have to really take a closer look at those and kind of wonder.
Well understood, you need to see a roadmap for the company to actually become a mine if they're a developer or junior, or for there to be growth as a producer, or at least value to be found. And also well understood that dilution aspect. What are some of the tangible characteristics one could look for to really see that roadmap through?
To go all the way through the cycle, I think that first it has to be what jurisdiction are you in? I mean, can you quickly get the permits to continue to get the drill pads that you need necessary? I mean, do you have the people behind it in order to have the wherewithal to raise money and the talent to attract the talent to get a project all the way through? I mean, a lot of there's an old saying in this business that men make mines. I mean, that's true, but you also have to have an ore body. But I do think that we are looking at a cycle here where you have to be cognizant of the talent that is out there trying to find and develop a mine and bring a mine into account. I mean, one of the things that happened on the last cycle was that a lot of companies said, "Oh well, we had the C team of the engineering company, and therefore the mine ended up not working well." Because there is kind of this dearth of talent out there. I had lunch yesterday with Oceana, and they were talking about how in the Philippines, the Philippines is actually driving a lot of mining professionals, and that they are taking those professionals and putting them across their entire business. And then you also see it down in Brazil, where there's certainly a lot more mining people going into mining careers, where it's less so here in the North America. And but that's something you have to be aware of, is what is the talent level that's out there? Can they build a mine? Will they be able to take it to the next level without screwing it up? So because there was certainly a lot of screw ups in the last cycle.
Are you guys still able to find value with where gold is currently at and the gold miners are currently trading at? Is there still value to be found?
Yes, there is value to be found, but it's not a blanket. Okay, throw a dart and this producer's making money or going to make money. You have to some companies that we have in the portfolio, and I would say that they're priced for $4,000 gold right now. And it might also get down to where you get a lack of product that's out there for the generalists to buy, and so they will change the valuations on how they're going to value the miners. I mean, you'll see NAV multiples go up. I think you can see NAV multiples go to 2 or 3, 4 times where they currently are. When the bigger money starts coming into the space. I mean, and that would get them back to where they had been at the peak of previous cycles. Or you can look at the gold XAU ratio, and that ratio will certainly get to a level that was back in the last cycle. It was I can't think of it off the top of my head, but so I'm getting too old. But um, you know, it will get down into the low fives versus, right now it's price for XAU, the XAU ratio, XAU's at 300, so, you're 1240, it's 1286 right now, which is, that's probably the lowest that ratio has been in a long time. But historically, it used to trade, in the 5 range, 3 to 5 on the gold XAU ratio. And the gold silver ratio is 81-42. So, that is a level that can certainly point to silver going to, much higher versus gold where it is currently.
Yeah, I would love to talk about silver in just a second. I would love to continue talking about price of these miners for a second. Of course, as a self-described value investor, the price you pay is incredibly important, just as much as the quality of the company is, or perhaps a bit more or a bit less, depending on your viewpoint. But for the price that you pay, the gold price is a huge factor, discount rates, margin of safety you would want, or the upside that you would need to see before you want to make an investment. So really, how do you view that trying to value a company, and what is a good price to you?
Well, you want to, view a company, based on, their cash flows, and what those multiples are, and what you do get is you have bear market cycles and ratios, and then you have bull market cycle and ratios. And I would say we're in a bull market cycle, and then it depends on what gold price you're going to use. But usually, in a bull market cycle, what you'll be looking for is, you'll be, at 10 times cash flow. What the miners tend to do is, they do get into spots where, they're building mines, so their cash flow is, could be negative for a year. But overall, you have to take that into account when you're valuing it and look out to the future. So I do believe that we're looking at expanding multiples in the sector, and that's part of opening the door to let more people in. And like I said earlier, is that if you get the Nasdaq to roll over, there's a big inverse relationship between the Nasdaq and gold historically, and gold assets. But here you've had the gold market running up with the Nasdaq being up at higher levels. So will we see that? Maybe this is going to be a news cycle that we've never seen before. Maybe this is a monetary cycle that that is being driven by the fact that the money's no good, and so we might be looking at figures, we're doing it based on dollars, and we're basing it on depreciating dollars, and so one day it looks, something looks expensive, and the next day it's cheap. So I mean, I think it's actually a crazy time, but I still look at it and say, okay, investors, where should you be? You should be positioned to have an allocation towards this sector, and then let everything else hopefully work out. It's kind of it's monetary insurance is what it is, or gold assets are.
Definitely well put. One of the pitfalls that you've outlined is really dilution. Of course, your company might grow in value, but if your share price, or at least your share value, doesn't increase, what benefit is it to an investor? What do you think of cutoff grades that are currently being lowered for some miners? They're expanding their pit sizes, or they're expanding their underground workings, and therefore increasing their potential revenue streams because the gold price has risen. Is that, you think, something to look out for?
Stijn, that's a great question. One of my pet peeves is that I fully can appreciate miners saying, okay, well, we have all this capital, we want to prolong the life of a mine, but what they can't do is get into this profitless prosperity of running the mine for the employees so the mine lasts longer. I mean, the mine was really designed for leverage to the gold market, and investors get into mines, gold mines, because if gold is was $1,000 and it goes up to 1,500, well, had a 50% move, and that's the leverage that investors want, and that's what investors participate into the mining sector for. What happened in the that 2000 cycle was that you kept on lowering the cutoff grade, and then you were buying bigger trucks, and when the gold price goes down, then you can't maneuver those bigger trucks in the pit anymore because you can't change the cutoff grade back up. So that is a problem, and some mines will you can't change the cutoff grade. The deposit is the deposit, and they have to take it as it is. But other mines, they can change the cutoff grade down to 0.000001 or something, and it's absolutely ridiculous because while it might make a little bit of money and prolong the life of the mine a bit, the investors didn't get in for that. They got in for give me the leverage to the gold price. I don't care if it goes another year or two. You're just trading. You might be trading dollars, but you're not trading real long-term free cash flow. So so I'm very much against companies that want to change a cutoff grade just for the gold price is going to allow the mine to go another 2 years or 3 years, whatever it is. Because these mines are actually hard to kill off anyway. But I do think that it's something that investors need to try to hammer home with managements, is to keep the margins. Let's enjoy the margins, and the gold price going up and margin expansion, and that will drive more investors to the space.
Point well understood, and a lot of these miners, of course, go crazy with lowering their cutoff grades. Of course, there's some mines that are still operating on pit shells of $1,650. In that scenario, would upgrading it be to, for example, $2,500 make sense to you?
Look, I mean, when you run a mine and you change that cutoff grade, and you might have to do a big pit layback. I mean, so there's capital involved in doing that. So it has to make sense. I mean, there's a lot of factors that are involved. It's definitely not just a straight line equation here. But there's ways to find where you can mine what some consider the marginal ounce, but maintain margins. And that's the key is can you get margin expansion and have reserves that and we will see it at higher gold prices. We will see reserves expand out because more lower grade ore will become mineable. But I just don't. From where I sit, I just don't think that is where the industry should go, because you can sit there and gold price can go to $4,000, and if you're mining gold at all-in costs of $3,500, what difference is it when gold was $1,000 and your all-in costs were $500? It's probably you were making more money. You had fewer shares outstanding back then. But my point being is that you can't be in this business, and if you're a management and driving profitless prosperity, you have to have create margin expansion, and that way the reserves in the ground are worth more, and having marginal ounces, let the marginal miner do that, and the established miners should stick to a strict cutoff grade.
Appreciate the seasoned experience and wisdom there, Greg. Appreciate that. Talking about silver and silver miners for a second, they definitely seem to be on your radar.
Yeah. I am very bullish silver. It's poor man's gold. It historically does well. I mean, I brought up that gold silver ratio at 81. What does that number go down to? I do think it will certainly contract quite a bit. Where it goes, does it go to a 50 or a 60 to 1? That's certainly possible. One of the things that is out there is that the gold price goes to $4,000, $5,000, $6,000, $7,000. It's harder for people to invest in gold and get an ounce of gold. They're getting a tenth of an ounce or whatever that fraction is. And if they want real monetary metals, they're going to be looking towards silver. So obviously silver is not in the central bank's vaults, but I do believe it does have a history that will allow it to increase in value, and seeing the silver miners. One of the issues when you're an investor is the silver miners trade at a premium to the gold miners just because there aren't that many pure silver miners out there. So it's I do see some silver miners that are starting to get some upticks out there. I mean, we've seen consolidation in that space too. I mean, last year, Silvercrest and Gatos were taken out, and and we had Mag Silver taken out earlier this year. So I mean, that's pure silver producers. They don't hang around long. So.
Appreciate that. And are you still able to find value in the silver miner space, even though it is a bit smaller than the gold miner space?
There's some value out there. I mean, you're starting to look for some of these projects that were mothballed, or they start to come around and find their way into other companies. So that's what you're kind of looking for, is where's the value going to be kind of going forward. I think it's probably projects that have been worked on in the past. I mean, because what happens, as we talked about earlier, is that the cycle is so long that you're looking at years of trying to bring a mine on, and so if you go through those cycles and then the equity markets dry up, well, the projects kind of die off, and so when you get into a bull market, they start to reappear again, and it might take a couple cycles for a project to make it all the way through. The real good projects, they'll withstand a cycle, but and silver was certainly beat up, so. There are certain smaller silver mines in Peru and other places that are certainly worth a look and probably will come to account, I would imagine, in this cycle.
Greg, you mentioned that silver is not in the faults of central banks, and that certainly seems to be true. Of course, might that trend be changing with Russia openly stating they'll buy silver in their budgeting for the next few years, and Saudi Arabia buying some SLV shares, which is, of course, an ETF tracking silver bullion?
Yeah, no, I think that's a good point. I think that just like the individuals, I think the central banks start looking at it and saying, okay, well, what's the next monetary metal? And you really only have silver and gold as monetary metals, and platinum, palladium, those are not monetary metals; those are industrial metals. Certainly, silver, does get the play of industrial metal. I mean, there's very few, strict silver mines out there. Most of it comes with something else, lead, zinc, etc. Silver is a byproduct. So a lot of companies who have streamed it off. So they just have thought, okay, the silver is not worth anything, so we'll try to get some money for it. And the silver streams have certainly been an attractive mechanism for companies that are financing projects.
And in the PGMs, the platinum and palladiums of the world, they might not be monetary metals in nature, more industrial in nature. Is there still value to be found if you look at their miners, for example?
I don't really spend a lot of time on the PGMs. It's basically because I kind of viewed our fund as a monetary metal fund, and so I have not looked at spending a lot of time on the PGMs, even though you can look at them as a rare or quote unquote precious metal. But they're starting. They are starting to pick up a bit. The price was certainly beaten down. I think the whole EV craze put a lot of pressure on the PGMs. Not needing as many catalytic converters kind of going forward, at least in theory. So they took a lot of investor demand out of that space, and you're starting to see a bit of a pickup. But so I mean that's kind of my take. Is I'm not really there looking for PGMs. I want. I think our investors that I know that are in our fund, they're looking at it from a monetary standpoint. They basically want me to make money for them, but and I do that based on we are a monetary metal fund, and that's kind of looking at gold and silver.
Understood. Greg, perhaps you can talk to us for a second about the OCM Gold Fund.
The OCM Gold Fund, I've been managing it since '96. It was originally started in '88, and it is a long-only mutual fund, and it has been has certainly been in position to where we've managed it for 25 years or more, and we'll continue to manage it. We have a long background in gold in the miners, so we're not doing other things. I mean, one of the things I think that makes it unique, and you mentioned our longer term track record, is because that's all we do. I mean, we're not doing something else. We're not worried about consumer staples or anything like that. We're strictly investing in the precious metals equity sector, and that focus does allow you to perform and understand where the markets are. So and then that will continue to be the case kind of going forward. So the OCMGoldFund.com is where you can get information.
Excellent. Greg, thank you so much for your time and your insights today. Really appreciate it.
Yeah, thank you, Stijn. Appreciate it.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.